It is Wednesday midday, right on the nose, 9:45 a.m. Pacific time. So we're checking out the market today. We thought today was a good day to have a webinar. Can everybody hear me okay? Yes, okay. Somebody was saying no audio. That's probably something on your end there. Okay, very good. Thank you, everybody. So what we're looking at here is here's the NASDAQ, and you stage this sort of Wyckoffean retest, as I like to call it. If anybody has ever read the book, Charting the Stock Market, the Wyckoff Method, I think it's by a guy named Hudson. Wyckoff has this technique whereby if you make a low here and you retest the low and the volume dries up and you start to come up off of it, that can often be at least a short-term bottom. And I think you did see a Wyckoffean retest. You actually closed at new lows here last Friday. Actually, yeah, that would be last Friday. And so I'm not sure why this range isn't showing there, but something seems a little bit goofed up. But you did close a new low, so you're in a logical position to rally. The other thing to think about is this, and remember I was talking about when you're on the short side, the one thing you want to be constantly monitoring is where the market is in relation to various support levels. And if you look here, this is a correction from last summer, and you're basically coming down right on top of the major range after the break off the peak. Okay, so you're in this range here last summer, and the top of that roughly is where you're trying to find some support currently. I thought you might see the market break to new lows over the past couple of days, maybe bounce off of this level, which is closer, into this congestion area, but apparently not. And I guess everybody's got hopes that QE 2.1 or 3 or whatever the heck you want to call it is about to come into force here. And so you get a nice rally yesterday, but I think it's logical. The other thing is when you think about where all of your short sale target stocks are, a lot of these things have been hammered, and they're in logical places to bounce. And I think if anything, yesterday's rally is simply evidence and proof of the fact that, and something I talk about a lot, is that during bear markets, the rallies are hellacious. If you're sitting there short and you've made some big profits and you're not taking them into looking for areas where you should at least be taking partial profits or just bagging the thing. And yeah, sometimes they'll go a little bit lower just to tick you off, but that's part of the game. So you're trying to take some profits. That's why I was saying some environments 10, 15% on the downside. Once you have that, you bag it 15, 20 maybe. So you have to kind of think that way. Yesterday I was pressing for more earlier in the day, and then I got pushed out before the end of the day on all my short positions. But things have come down and made some money on this break, and then of course on this rally, I mentioned right around here we put out a short sale setup telling you that all these stocks had come up into logical resistance at a major moving average. And if you look at a lot of let's go to what we got here, daily chart. So I mean, look at the ones we mentioned, for example. You came up into this level and then you broke hard. Now you're rallying back up. Still think you're probably heading for this low eventually, but it comes back into shortable range. And that's kind of typical. They're not going to generally just break right down and go straight to the downside. Sometimes that'll happen, but there's a little bit of stutter stepping. So given the fact that the market was coming down to a potential low here, there could have been some profits taken here. You're not getting much, but you could kind of see where the indexes were in terms of where the NASDAQ composite was coming down to this 2300 level or just above it. So, and support levels to me are fuzzy. There's fuzzy zones. So when you start getting to an area where it looks logical, then you're in position to have a bounce. And I do think that, when you come off 18.6% on a closing basis on the NASDAQ in such a short period of time, you're bound to have these sharp bounces. And remember, we've talked about looking at the 2010 market and the 2008 market. So let's, for example, you look at 2010, and you had a sharp break, and then you get these rallies, and you break again, test the lows, and then you get to sort of chop around for about a month, and then you break down to new lows. I tend to think you're somewhere in here, and that you probably see some rally. You don't know how far, it could go all the way to the 50-day moving average as it comes down and chop around a lot. There's a lot of news to sway the markets. There's always the potential for QE 2.1 and however the market reacts to that. We don't tend to think, and Dr. K, speak up if you disagree, but we don't tend to think that QE3 is going to do all that much for the economy. in terms of propping up the U.S. economy, which is what they've been trying to do, making up for this demand gap that we've seen over the last 3 years, or 2 years, 3 years, say. And so, while it may have an effect or have no effect on the economy, then it may actually prop stocks up just on an inflationary theme in terms of the declining dollar. So there's that potential too. So you kind of have to keep your eyes peeled for that. But I don't tend to think that a QE3 will do anything for the economy. Dutch K, you got any take on that?
Yeah, I mean, I think it really comes down again to price volume action. The model's going to be looking very carefully at how the market reacts to Bernanke's speech in Jackson Hole on Friday. So in other words, if Bernanke gives the market what it wants in the form of QE3, like he did last year, then I would like to see leading stocks and major indices shaping up and offering a follow-through day, a proper follow-through day, much as it did last year on September 1st. On the other hand, if Bernanke is a bit fuzzy about QE3 and decides, as he's been doing so far up to now, being a bit nebulous about it, and the markets start to sell off in earnest once again, then that's a wonderful sell signal for the model.
So right now, neutral is the place to be. You did have a follow-through yesterday. I'm showing the NDX because for some reason I'm not sure what's going on here on my NASDAQ chart. It's not showing today's range. And it's just showing a little bar here. So I use an NDX, but what happened basically is this was your first rally day. So you're 11 days out yesterday, and you get a move. So you never went below the intraday low of the first rally day. So the rally phase technically stays in force. When we were at O'Neill, this would always become a point of controversy. And the bottom line is, yeah, okay, so it's a follow through, but remember, we always look in terms of what do you buy, where's the leadership, and there's really nothing going on out there in terms of leadership. Everything is just kind of coming up off the bottoms. So for now, you got a follow through day. You basically try to get above the 10-day moving average. Couldn't hold it this morning, so I don't know where you're at now. It's actually looking dicey to me. This could fail right away or can continue rallying. I think if you're trying to play the short side, okay, first of all, with the ETFs, you're waiting for a sell signal on the model before you're going to buy any inverse ETFs. However, you can play it differently on a stock-by-stock basis, depending on what you're seeing in certain target stocks that we've talked about. So the one thing about Ascena is that even though it's gotten above its 200-day moving average, it really hasn't been able to get above the 20-day or really the 10-day over the last 3 days. So to me, that's kind of a trailing stop area if you're shorting it. Now notice how it comes down here, undercuts this low here, just barely intraday. That was like, I think 89.20 something, 28 or something like that. What is that? 89.26. And so you rally back up. It's starting to break down. So I still think this one's in force using the 200-day moving average as your stop. If it rallied back up in there, I probably would be all over it on the short side. It may just turn out to break this low anyways. It's going to depend on what the market does in the short term. But this is to me a very bearish-looking situation. The first target on the downside would be this 82 low here. The second target would be down here, well below 80 at 77.33. So those are really your targets. Sohu is also one you can game here. Notice this morning it rallied right into the 50-day moving average. That's the blue moving average here, and starting to roll over pretty sharply. Volume is, I think, is very heavy on it right now. Let's see. Yeah, it's running about 23% below average. So it may just pull back and you're on back and fill. But see, again, this becomes a shorting opportunity this morning if you're on it, regardless of what the market did yesterday. So, ultimately, I think your targets are either this low here, down around 65, or this low here. Another one that we were looking at was Monsanto, and of course, that's rallying back up. I still think your targets are initially be this low and then this low. So, you're coming up right now, and there's not a lot of volume, 60% below average right now. So it could make a couple of tops here. It could go a little further and maybe break down. And then you can keep an eye on some of the other ag stocks, such as Mosaic, which is bopping around here right at the 50-day moving average. And you got Potash doing the same thing. And it actually seems a little bit weaker around the 60-day moving average. So these are stocks I'm keeping an eye on the short side. And some of the others that we've looked at, LBS is doing the same thing. It's just kind of in between the 200-day and 50-day right now, holding right at about the 50-day moving average. And these might be short of one. You could actually take a shot at them using the high of the day as your stop, and then you may have to game these or work these for a little while before they start to break down, because that is going to depend on how fast or how quickly or how soon this rally in the general market pans out. And so you want to keep track of all those target stocks on the short side and just see where that ends up taking you in the near term. So you could just get stopped out very quickly. But you can come in and take positions, maybe smaller positions, and test them. And if you just get pushed out, you just come out real quick and see if the thing rolls over. But you could be in chop land, and you could be in chop land, as Dr. K was saying, until Friday, when the much anticipated speech in Jackson Hole, Wyoming, by Bernanke comes out, and we see what's going on. But I don't know. It's like I think it's overdone, and you may just drift higher until then you roll over. But longer term, we're in a bear market, and I think we just continue to play it that way. So rallies are things that we're looking at to go short into, and at some point you just kind of got to wait it out and play it as it's rallying, because you don't know for sure at which point things will really start to break down and roll over again. So all we're looking at right now is to see if this thing's going to break down from here. But it could chop and slop, just like we're looking at 2010 last year, where you after the second break here, you retest it, and then you just kind of chop around. You can do that for a little while. So you have these little shorting breaks that you can hit real quick if you want to trade them. And I think in a lot of cases on the short side, day trading and short-term 1, 2, 3-day trading comes into play a lot, and so you should be open to that if you're going to try becoming a short seller in this environment. And I think you do have opportunities, and you can see if you had come in this morning, you could have hit. Oh, that's looking right. Let's go over here. You can see you could have hit Sohu, and you'd be up a few bucks, $4 on it. So what's that? 5%, a little more than that. So you could be making a little bit of money there. Another one I was looking at earlier is RAX. Comes up into the 10-day moving average and reverses. You're not seeing a lot of heavy volume, but that may be it. Comes and fills the gap, that sort of thing. And just you can use the high of this morning as a quick stop and just operate on that basis. So I don't really think you can't test the short side here. Whether you're going to be successful or not is going to depend entirely on what the market does. So, meanwhile, somebody's pointing out that there was a Hands breakout. Hansen's, I know they make monster drinks. My brother works in an ER, and he's a big fan of monster drinks, I guess. I myself avoid them, but it's just my preference. But I guess that's their big product these days. And so you get this breakout from this kind of deep, jagged sort of double bottom thing. It's very short, a couple months long. But would I be buying it? I guess, you could buy it. It's coming in right now. So the breakout level, I guess, is somewhere around in the 82 level, so you're within a couple of bucks of that. Would I be buying it? Probably not. But I think I'm just waiting to see what happens on this rally and when we want to go short again. We'll go through some other stocks here, like UA, rallying. Here's another example of a rally. But see, a couple of things to go on here. If the market rally continues, it could go past this high. So if you wanted to try and test this short out here, you're probably using one of these highs of the moving average as your stop, whatever you want to do. Because it could rally all the way back up to the 50-day if the general market continues to rally. So that's really what you're faced with there. So some other ones, looking at Baidu, because that one also rallied up into the 10-day, didn't quite make it to the 50-day, now it's coming in. But these things can just chop and slop for a period of time before they break down. So it doesn't mean that you can't take short positions here, and if they remain within your stops, you can go ahead and sit with them, because they'll take some time to break down. And I do think you're basically still working on the second wave of selling in the market. So I think, we've got for some reason I can't type today. Today you've got this I think is the first wave, and now here's the second wave. I'm thinking it's going to resolve itself lower from here, but you might have a little blip. So when I look for 1, 2, 3, sometimes 4 waves to the downside total, and I think once you get to that point where you see 3 or 4 waves of selling to the downside, if you're still trying to short, you're a little bit late in the game. And we saw that, as I was pointing out last week. 1, 2, 3 waves where you break to new lows. 1, 2, and then by this time you're pretty much done. And so if you were shorting, making a lot of money, I made a lot of money last year during this period. And once you got to the end of July, that was pretty much it. So you're washed out once you get 2, 3, or 3 to 4 of those types of selling waves to new lows. Okay, so when I look at that, I'm thinking we're looking at several waves that are going to take us lower. So we think on the downside, 2061 is as low as you'll get to the on the NASDAQ, and maybe 1010 on the S&P 500. In the near term, you're finding some support here, but we'll see how long it holds, assuming it does even hold. So that's really where we're at with the short side. So let's see. Let me see if I've got some other things here. I've been reading. Somebody who likes Kevin Marder's stuff on MarketWatch. Actually, Kevin did point out in his piece on Monday afternoon on MarketWatch, he pointed out the Wyckoff-ian retest. So that was good. He picked that off in terms of a near-term low. Gold, okay, somebody's saying CNBC commentators say gold is in a bubble. I disagree with that. I think that you have a very sharp move to the upside, and so you need to correct now. You probably bounce off the, I would be looking for 1738 on the downside, which would take you down to the 20-day moving average roughly. That would be a decent pullback. But normally in gold, you'll see 8.5%, 10% pullbacks. And really, what is that? It's about $150, I guess it'd be $190 now. So that's really pretty well contained so far. But you got to expect when it goes into this mode, you don't want to be buying it here. The pullback here is to be expected, I think. And of course, when somebody comes out with an article yesterday saying you're going to 3,000 in gold, I guess that's probably the time when it's going to pull back. But it had a nice move. And, we kind of blew it because we got out a little bit earlier on our gold. We made money on it, but it had a better run after that. So watching for a re-entry here. But I don't think it's in a bubble in the sense that it's artificial. There's a sort of artificial demand for it. Something like we saw in the .com era, where there's nothing there, no sales, no earnings, and just a bunch of conceptual companies not really making any real money. So I don't think that's the case, and I don't think you have a situation where the Fed is pumping money in through QE1 or 2 or 3 and driving stocks up and creating bubbles that way. I mean, think about monetary policy has been so accommodating for so long. And even recently, with Treasury rates now, close to 0 on T-bills, now they're talking about Operation Twist, which essentially what they do is they start selling the short end and they're going to buy up to 10-year. The idea there is that if they buy the 10-year Treasury, they're going to drive the Treasury rate down, so the Fed will come in and buy up 10 years. And I think they did that the other day. I think on Tuesday, Monday or Tuesday, I think it was Monday, there was an $822 million primary open market operation. So there's a bunch of money being injected into the system on that day. So by bringing the 10-year Treasury down, that's tied to consumer rates. So the thinking there is that that'll help consumers out. But I don't think people, when they're not really working and unemployment is so high that you're going to have lower interest rates on the consumer end helping to spur buying. If so, you're just creating more of a bubble, and so we have to think about what kind of bubble is being created in stocks and possibly the economy that's subject to bursting. Gold is going up on the basis of the fundamental concept that fiat currencies are really what rule the world today, and so you're going to see these fiat currencies continue to decline in value while gold goes higher. So the long-term trend for gold is still up. Pull back to 1738 on the futures. Corresponding to probably 169 might be a buying opportunity here. I wouldn't use the 10-day, and even see if it violates it. Sure, you may have a close below the 10-day today, but we'll see if it goes any lower. So ultimately, though, the 50-day would be support for gold. And could it pull back there? Sure, why not? It's done that before. If the market gets a lot worse, there's that potential. But we still think that long-term gold and silver are both going to go higher. So that, of course, brings us to silver. And there's a very simple dynamic going on here today. And that is, we're going to shrink this just a hair so you can see what's going on. But, you have the climax top. And the other thing I'd point out is that silver had this massive move from 20 to 50 on its big run here. And gold hasn't really had that kind of a move. Now, I know silver is 2 to 3 times more volatile, but I would think that gold, you'd see it up 30 or 40 or 50% from a breakout point before you got into any real climactic top. Now, getting to silver, the problem with silver here is probably this, and Dr. K and I were discussing this, because obviously the breakout, thinking you could buy the breakout, that analysis is flawed. Okay, that the objective evidence shows that was flawed because it broke out and didn't hold the breakout. But our thinking is you should be able to hold the 20-day, and you're not even able to hold the 20-day here. So what's the problem? Well, the problem is that you had a wedging rally here, and then you broke out. So silver tends to be volatile, and apparently there weren't enough weak hands shaken out or pushed out with some volume buying. And so this is essentially wedging before the breakout. Sometimes that'll work, but in this case, I think there weren't enough strong hands in the silver to cause a breakout. And then when it comes off, or when gold comes off, it's going to drag it down. So really now you could be getting another test coming in down towards the 37, 38 level, so we kind of watch it there. But it's getting smacked around pretty good today, and I think that's really what the dynamic is. But I thought, in general, that's a pretty good trade coming in on the breakout here, or trying to buy off the 10 or the 20-day, and then just going out very quickly if you get a violation. So, but it's going to be volatile, but if it doesn't work, it doesn't work, and you have to blow it out and move on, I think. But we'll see where this ends up on the day. It may be telling you that there isn't going to be no QE announcement coming from Bernanke, and maybe the run-up in silver and maybe the run-up in gold is all predicated on that perception. So in the short term, they're going to correct. So that's pretty much where that's at. And really, that's getting to a point where if you can't hold the 20-day, you should probably just be blowing it out. Would you agree, Dr. K?
Yeah, I mean, you want to be careful with where GLD has been, because it's been more extended than it's been in quite a long time. So it deserves to pull back here. But if it could very well undercut the 20-day, just because if you look at the prior run-up of GLD, what it does is it comes off pretty hard after a big run, and this has been the largest run it's had. So it's probably going to come off even harder, and then it bounces around. It allows the 50-day to catch up to the price, and it bounces off the 50-day. So I wouldn't be surprised to see that kind of action with GLD, with gold, and then, of course, with silver, since silver itself tends to correlate highly with the metal.
Yeah, and so maybe that we're looking at, you're going to see a period of consolidation continue with the metals, and that the market itself is starting to catch up with stocks. So everybody stops selling stocks to raise capital, and they go after the metals, which have been up. So to me, it makes somewhat a bit of sense, and the pullback levels are what we'll be watching. But it may make more sense to try and accumulate gold if you're inclined to build say a hedge position, or a position to hedge against declining currency somewhere among your assets as an allocation trade. Then I think you're probably better off trying to buy on the pullbacks. So I'm going to get to some more stocks, because everybody wants to know about stocks. Here's a classic breakdown. It's Apple's trying to break its 50-day. So far, it's finding support along the 50-day, but notice how it's finding resistance now at the 20-day. That's actually very common for late-stage failed bases. You'll get one period where they go, bonk off the 50-day. They look like they're going to break, and that's also the prior breakout point. I should make this bigger. So, here's your breakout. Let's shrink this a bit. There we go. So here's your breakout level in here, kind of this zone. So you're finding support along it, but notice how you're getting resistance up at the 20-day moving average. So I think this argues for the potential for Apple to eventually break. So 1, 2, Now watch, the rule of three could come into play, where the third time everybody thinks it's going to bounce off the 50-day moving average, and it doesn't. And I think if Apple tops, that's a major statement about the general market and the continuance of a bear market of longer term duration. Okay, so that's, to me, that's one to keep an eye on here. If you wanted to short it here, yeah, you'd use the high of today as your stop, or the 20-day at 376. So you're actually pretty close in there right now. But I don't know what the volume rate is on Apple right now. It's running at 14% above average. So yeah, it's running into resistance at the 20-day without question, in the 380 level roughly right now. So that could be heading lower. The other thing to do is just wait till you see this break of the 50-day, and probably what happens is when it gets there, market's coming off and it gets there, you would short it right there as it's going through the 50-day and expect it to continue lower. And your first stop would be down here on the 200-day. But Apple's, as we know, broadly loved stock, so it always gets support. So maybe you're better off going after something else. And of course, price line. Look at price line. Reaction rally undercuts the low. So look, if you're shorting, and on Monday you were short price line, and it undercuts this low, and it's below the 200-day moving average, okay, you can take profits there and then look to set up on a rally. Now notice how it goes past the 200-day, fills the gap, and it's looking like it's getting resistance here. So what do? You can come in, you can short this using the high of the day at 487.97. Right now you're trading at 478, so that's like 2.5% higher. So you just scale your position properly, or see if it rallies again. We'll see where we end up today, but I wouldn't be surprised if we were down reasonably on the day. So this could just reverse very quickly. Or remember, like we saw the last time when the market rallied up off the lows a week or so ago, and then rolled over, it took a few days for things to break down. So you could see things sit around here for 2 or 3 days. Price line definitely, and that's what we've been talking about. But you can see here on Amazon, same thing. You undercut, you break the 200-day, you undercut this low here. So it's a logical place for an undercut and rally type of situation. Notice if you come up, you fill the gap here. So again, you got a shortable situation using a 196.31 high. That's about 3.5% from here. So you might wait and see if it tries to rally. The other thing is, keep in mind, these things could bounce higher. Again, it all gets back to one simple concept. When the market rolls over, these stocks are going with it. If it doesn't roll over and continues to rally, then these things will continue to drift higher. And you get what I call floater type rallies, okay? And that's basically what you're looking at. And that's why you have to come in and test the short side. You're going to come in and you can short and say test here, and maybe you get stopped out right away and it rallies higher. But you're going to be working this, and you can start out with 10% positions. When I'm playing smaller, I'll probably go with 20% positions, 25% positions to start. That way if something rallies against me, it's only going to hurt my portfolio maybe 1 to 1.5%, which for me is very tolerable. And that's how you can try and play it. And so if you get stopped out, you're getting dinged a little bit, but the idea is when they do break, you're going to do pretty well once that occurs. But again, you got to be keeping an eye on where the market is, understanding where the support levels are in terms of looking at longer term charts. Just like go to this one. Let's look at the monthly. This would be exciting. So you can see how this works here. Now you can really see the support on top of this area from last year, and going further back, you figure you could eventually test the low here, which is 2061. But possibly, if you look at it, this is a NASDAQ since 2000. So has this been a crappy decade in general for trends? Heck yes. And it's still that way, and you're way off the highs. And could you go back to the lows down in here? Sure you could. And this would be very typical of, say, the 1970s for the Dow and the S&P 500 until you finally broke out after a period of 10 years or so. Just chopping around. So when you look at these lows, we could definitely head down there, but in the near term, you're getting close to, and I wouldn't pay attention to the moving averages because this is for a daily chart, but you can see you're coming near term, you're coming into this area of potential congestion and support, so you may bounce for a little while. You'll get a sense of how weak we are by how quickly, how far we break off of this rally. So. Somebody's asking a question, I guess, about short selling, and asking if you feel a stock is going to break to the downside, do you play heavier initially, or do you wait for confirmation of a breakdown before piling in? The way I like to do it is just, if they're coming up to an area of resistance, I'll just try to get in on them there, and once it looks like it's starting to give way, then I'll really pile in. So sometimes just pile in, and if you get stopped out real quick, it really depends on what sort of stop you're using, how big of a position you want to play. So the bigger I play it, generally the tighter you want the stop to be, and the lighter you play it, the bigger the stop can be. So it really depends on that. So a lot of it also is what is the position in the market. So I really thought, this rally in a lot of stocks, UA was one of them. Rax was actually one of them. It had this rally right up here. There were several like that broke really nicely over the prior week, and so it's really fast score right there to be made. I think that when you see that sort of thing and it comes into an area where you're just, especially if you're just past the moving average and coming into a prior area of support that now becomes resistance, a lot of times you can try and get very heavy there. Look at Aruba Networks, and we can go all the way back, to this rally here, which became very shortable as the thing broke out, or even this rally here after this sharp break. You see how it just starts to break down, and you could come into it right at the 10-day on this one. When you get past the 50-day on this one, now this is really starting to look shortable up in this range, because you're coming up into this area of potential congestion, which then provides resistance. And so it's coming in here, you can get really heavy. And I did actually get very heavy in Aruba right around here, and covered too quickly because I could have made a lot more money on that one. But that's a situation where you've got a lot of things kind of working against the stock in terms of resistance, and the fact that it's faked out a lot of shorts possibly by going past the 50-day moving average is very common. And I think when that happens, that's a time when you can get aggressive. Okay, but a lot of times, yeah, I think you're way too short on this. By the way, somebody's asking, Riverbed, yeah, I think you're a little late there. Travel Zoo, I think you're a little late there. But I think you're looking at some situations that are still in early stages, and these are major, major moves. Priceline, Amazon, Apple potentially. We're talking about that one. Let's look at Baidu. I think some of these Chinese internets could be in major breakdowns, but you could be at a point where you're just going to chop and slop around for a period of time. So let's see, we're watching silver here. Still coming down. 39, 42. I don't know, it doesn't seem to really want to be stopping there, Dr. K.
Yeah,
what's your strategy?
That's the nature of silver. It's going to be very sloppy, especially when you look at the formation it's traced out since it bottomed. So, again, the biggest bearish concern I had over silver is that the market might construe it more as an industrial metal, and if the whole world goes into recession, it's going to pull down silver along with all the other commodities. But on the other hand, I think a stronger argument is that silver really is a true hybrid. It's considered a currency as well as an industrial metal. So I think it's going to get dragged up along with gold. Once gold finds its footing, gold's going to start toward 2000, and silver should run along with it.
So if you were buying this breakout, would you be blowing it out?
No, I mean, obviously we've advised everyone, and ourselves included, to pyramid into these positions and let price prove itself. So, having bought a position on that breakout, it was a small position with the intention to add to the position as the price was higher. It never got to that second price point, so we're left with a small position in silver, which allows us to sit tight with it and not really be very concerned. If it wants to go a bit lower from here, that's fine, because it's a small position. In fact, if it goes lower from here and gold pulls back in a constructive manner and finds its footing, I would say that could be an add point.
Okay, just wanted to get a real-time update from you there. Let's see, someone's asking about Polaris Industries. Is that a head and shoulders? Well, here's what you got. You know, there's a bunch of patterns that look like this. CRR, you know, looks like exactly like that. I think there's a couple others. SodaStream, which is really hot, you know, that has something. Well, no, it doesn't really. But CRR looks like that. I'm trying to remember. There's a couple others that look very similar to that. And of course, I would say that that is a head and shoulder formation. And you could be, you know, one right shoulder. Here's a second right shoulder. So maybe these become shortable here. But again, that's all going to depend on what the general market does. If the market takes a rally, this could rally higher. Now, generally, what you'd like to see, if this is your left shoulder here, and this is your head. Remember, the big break on big volume is the right side of your head. Here's one shoulder, but you know, if we look at a weekly chart here, it's not that well formed out. So you know, this could rally back in here, but you'd want to see it, the right shoulder, the peak of the right shoulder form underneath here. So let's say if you did see a rally and it went to the 50-day, it would be below the peak of the right shoulder. So if it starts getting up in there, you might look at it as a short, but it could also become shortable right here as it's coming up into the 20-day, because it might find support there. So again, you know, you could test a short here with the idea of using the high of the day or the 20-day as a quick stop and just do it that way. So, but my guess is it might take a couple, 3 days for some of these to work. We'll see if something breaks down. If the market, like I said, if the market breaks down very quickly here on this rally, then obviously these things are all going to head lower in a big hurry. So, and I think you kind of have to guard against wanting to be a pig and getting short the whole planet. So, because I think that that could be a problem right here. You kind of want to wait and take your pick your spots. So, let's see. We'll answer some more questions, but I think that's pretty much where we're at right now in terms of the overall market, in terms of gold and silver. I'm thinking mostly cash probably is the best place to be right now, and you know, working some shorts. You can test some shorts, and they might work in the short term, and you can day trade some of them, I think. But we'll see exactly when this rally rolls over. But I think you got to make a lower low in here over the next week or so before this thing really has a longer rally. But you are in an area where you could chop and slop around. Let's see. A lot of people are asking any thoughts regarding trading during Bernanke's speech on Friday, and there's really Dr. K kind of went over that. If they announce QE3 and you get a big follow-through day, well, then maybe you're off in buying stocks, or probably better off. You'll see the precious metals start to run higher. So, Dr. K, the phone's for you.
Thanks.
Did you get that? Is that your mother?
Oh, she's doing great, but it's not.
So someone mentioned Biogen. Yeah, this is another one of these patterns. You see a lot of these, and they're starting to look like head and shoulders formations. So I think yeah, that could be a situation to keep an eye on here. So you can see the market's starting to rally. So it's continuing again. The Dow's up again. You can see the Nasdaq is trying to recover here, but we'll see where this thing goes. But you're all over the place right now. Let's see. Do you keep your stops on gold and silver at 8%, or do you let them go further down? It depends. Dr. K, you want to answer that question?
Yeah, I mean, if you're really with any position that you're going to take on, if your maximum stop loss is 7% or 8% or whatever level it is, make sure you adhere to it. If you feel that the trade has gotten away from you, then don't take the trade at all. So, with instruments like GLD and SLV, SLV tends to be 2 to 4 times as volatile as GLD. And also keep in mind that if you're going to invest in AGQ, that's twice the volatility of SLV. So, do the math on that. If you're going to take a stake in AGQ, either size small enough so that you can maintain a level of flexibility in the position. Because when you buy AGQ, expect it might run against you by easily 12%. Which is 6% on the SLV, and that might be 3% on the price of gold or 2% on the price of gold. So expect turbulence and position size accordingly.
Yeah, that's pretty weak this, I think this action day is pretty feeble as far as silver goes. Um, names like AGP don't give us a chance to short. Well, I don't think you really need a chance to short AGP. I'm not sure if it was the biggest. Well, it had a nice move, but this is breaking down on crisis type situation. But I don't know about shorting it now. It's too far down there. So, but you had a chance to short it here when it started to break. If you want to try and play that break in the 50-day, the first breakout, late stage breakout failure, breaks the 50-day, first rally up into the 50-day, sometimes can be shorted. But to me, that's kind of mostly a hindsight trade. Are we using exponential? What I use here is, you can see here, up here, you see moving average calculation of 50, 210, MA 20, and that's an S, so that's simple. These are all simple moving averages. The pink line is the 10-day, the green one is the 20-day. I know some people like the 21-day, some people like the 20-day. The blue line here is the 50-day. The black line is a 65-day exponential, which is a moving average I like to use when I'm working on the short side. And then the red line is your 200-day simple. So that's the array of moving averages. So the nice thing about moving averages is that if you put enough of them on your charts, your stocks will be finding support or resistance everywhere. So they'll set your mind at ease if you put enough of them, because you'll feel like your stocks are doing just what they should be doing, following some moving average somewhere. So, and that's a joke actually. That's what I refer to as MASS, moving average stress syndrome. How many moving averages do you need? How many different intervals, and whether they are going to be simple or exponential. So everybody has their favorite moving averages, but I think a lot of them are just a factor of learning how stocks act around moving averages. For example, in the past, we found that the 20-day moving average was always useful for the SLV, because you'll note the green line here, you see it has found support, and we finally violated that. You could get out, let it correct. So now what we're seeing here is it really isn't following the 20-day moving average anymore, so it's a little bit weaker on this thrust, and that kind of tells you what's going on, because the last time it broke out, it stayed well above the 20-day the whole time. So it's sending you a message here. So, but again, the 20-day moving average in this case with the SLV worked a certain way. So my point is that with different moving averages, you will learn how certain stocks, certain ETFs act around certain moving averages, and you find usefulness in these thereby. So that's really the story with moving averages. The black triangles, okay, we have some newbies around, I can tell. If you go onto the website, you can actually find the EFS, the .EFS file to download. I think it's in the download section of the website. And basically, when a stock is up 12 out of 15 days in a row or better, these little black triangles, which I call ants, will start to show up. And it's just something that we used to use at O'Neill. It's less useful these days, but it tells you when something is getting very extended on the upside after a long run, or if it's getting very powerful. You usually see something like this right out of the gate. So, for example, look at GLD coming out. When it broke out, it started to show after the breakout, this very powerful, so it continued higher. Whereas SLB back here in May, after it had already broken out and run up and it was in the climactic phase, it's telling you it's getting extended. So there's kind of two ways I can use this, depending on the position of the stock. If you have a stock up 12 out of 15 days in a row or better right after a breakout, that's usually a sign of power. Much as stock going up 20% in 2 weeks or 2 to 3 weeks after the breakout is also considered a sign of power. Conversely, when you start to see these things show up at the end of a long run, and we got to remember silver, running up. So you notice how you saw some here not too long after the breakout. Those were very powerful, and you didn't really see them again until you got into this climactic phase, and so they became useful. It's just an indicator we use. It has different relevance in different environments and with different vehicles. So, are you seeing anything setting up on the long side? I don't see a thing unless you want to buy Hanson's. But I haven't really seen a thing on the long side here. That's why my tendency is to think that this rally will be shortable at some point. And you can even go after stocks now with the idea that maybe it fails in the next couple of days. Dr. K, are you seeing anything on the long side? I know you're long airplane tickets to Moscow, and you're heading out after the close, you dog.
Yes, that would be right.
But anything else to be long?
Well, I got to say, the only stock that I think has that really has bucked the trend completely and formed a proper structure is Hands, and that I would, for those who want to be long stocks, Friday could be the turning point. That could be a follow-through day in the model, and the Hands is showing the most strength, so that's probably your best bet if that kind of scenario would arise.
Hands, huh? Wow. Hans. Yeah, I'm thinking of Hans and Dita from Saturday Night Live. Those workout guys. We're going to pump you up. Anybody remember that? Am I dating myself? So,
not too bad. That's late 80s, I think. 20 years ago.
Yeah. Gil, you said you are a fan of candlestick charts in your book, but only saw you use it in a couple of reports on Gilmore Report. Well, sometimes I show them, sometimes I don't. The thing is, if you start showing candlesticks, you're risking freaking a lot of people out who are new, and they don't like to see that sort of thing confusing them. So I don't bring them up all the time, but I look at them. I look at them on a daily basis and look at different stocks. So. But I don't show them a lot because it's not necessary in most cases, and usually they come in at critical junctures in a market phase. So that's why I don't show them a lot. Doesn't mean I don't use them. We could use them more often, but we're thinking you might get more questions than answers. So somebody asking, I guess, is this a personal question? How did you and Dr. K decide to work together? You seem to have a very different personality. Just curious. Well, as we like to say, Dr. K and I are exactly the same but completely different. So, and you have to know us to really understand that. But I can tell a story when I was at O'Neill back in '97 when I started working for O'Neill. I was head of the institutional group, and I was also an internal portfolio manager. So, O'Neill wanted me to have an analyst. To help me talk to the institutions and to talk, be able to understand the market and to do studies. And so I ran into Dr. K one day. Where was that, in the bathroom or something?
No, I think, you know what, you came right in my office. I think you...
Oh, that's it. Yeah, because I remember, I remember Bill saying that, I guess... there are people, there's a lot of politics played at O'Neill, and there were other people there, and I won't name their names, but they tried to get me fired when I was first there. They tried to keep Dr. K from running money. And so I just remember one particular meeting where a bill was coming down on a certain individual who used to run money there, and he said to him, and even little Chris is picking ideas and running circles around you. And so I wanted to find out who the heck is little Chris. So I asked Phil about this, and at that time Dr. K was working in literally a closet. It was a room that had been a former closet, and they turned it into his office. And so I just went in to visit with him, and we hit it off right away in terms of being able to talk about the market. He went to Berkeley, I went to Stanford. As most of you may know, the two schools, we have a rivalry. And every year, the big game, the two schools fight over the axe. It's this red axe that the winner of the game between Berkeley and Stanford in football gets to keep. And so Dr. K and I bet $1 every year. So I won this year, but last year I lost. So I think I think Dr. K, you're ahead by $1 or $2. But in any case, we just keep a balance sheet in gold bullion. We move whoever wins the bet, the gold bullion is moved into their vault from the other vault. So we never actually cross anything between ourselves. But we just got along pretty well right away in terms of the market. But we're very different, I would say, in so many ways. But in terms of our ability to work together, I haven't really found anybody that I can work with as compatibly, and also with the idea of not having to worry about what does or doesn't get done. We kind of tend to instinctively know where to fill in the gaps. And so when we were at O'Neill, there would be other portfolio managers working on studies, and I'd be asking Bill, where are these studies that we're supposed to see? And Bill would say, oh, well, they're working on them. And so I would call up Dr. Kane and say, hey, there's a study supposedly somebody's working on. So, for example, I remember we did an optimization study of follow-through days. And somebody had been working on this for weeks and weeks, and there was still no answer. And so I called up Dr. K one afternoon, and I said, hey, can you do an optimization study on follow-through days? And, of course, within a few hours, he had the study done, and we showed it to Bill. And that's kind of the way that the two of us moved up very, very rapidly in the organization. The other thing would be our strong performance as internal portfolio managers. But I think that a lot of people don't have to be exactly the same in order to be very compatible in certain areas. So with Dr. K and I, as working partners and co-owners of Mocha Investors, and now the new company that we've just spun off, Virtue of Selfish Investing LLC, which is now a wholly owned subsidiary of Mocha. Yes, things are just getting too big. We're trying to spin things off. We will be going public soon enough, so stay tuned. Probably right after Facebook. But it's the same thing with being married. My wife and I are very different, but we have a very strong marriage. We've been married almost 18 years, and a lot of our friends have fallen by the wayside. I just think there are certain energies that people bring to any relationship, and they either mesh or they don't. And people you think would be perfect for each other based on their personalities being similar, a lot of times that doesn't work out. And that's kind of how it works. It's kind of serendipity. And then Dr. K took off in the early 2000s. I took off from O'Neill in 2005, and we worked independently, working with other people, which I think for both of us, I can say, and interrupt me and correct me if I'm wrong, Dr. K, but in both those cases, the situation that you had gone to work in and the situations I had gone to work in did not help bring anything to fruition. They actually created some serious problems because these were not O'Neill-type people, and there's a certain mentality of being an O'Neill manager that comes into play when you're out there in the real world, and it's too easy to get distracted by the opinions of other people who don't have an O'Neill mentality. So, and as Bill O'Neill himself said, you go out there and run money, the public doesn't understand what we do. And he said, well, you get hit once and everybody's going to want to sue you and make a big scandal out of it and all this. And he's right. Because people don't understand what we do, and so they don't understand that we can drop 20-30% and really not think about it, and come right back and be up 50%, which we've done. Dr. Kane and I have done jointly one month this month, or this year rather, and I was up almost 100% in 1 month last year. So that that's kind of the O'Neill ethos as far as we practice it. And so when we had both gone through this experience of dealing with non-O'Neill type people in terms of trying to start businesses and run money, it just didn't work. And I would say in my case it was disastrous. In Dr. K's case it didn't work out very well. I mean, how would you describe it, Dr. K?
Yeah, I mean, actually our first year we did in the top 3% of all the HSBC ranked funds, so that was good. But that's when, the second year, there were, egos rubbing against each other, and too many cooks in the kitchen, and it created problems down the line. And so it was a good lesson for understanding the differences between constructive interference and destructive interference. And I think most interference out there is quite destructive, especially when you're trading the markets in the manner that we trade, which is very unusual and unique compared to the way the street views it, or out here in Europe, where people tend to be ultra-conservative.
Okay, somebody says they're getting teary-eyed. You guys should get a room. Yeah, really. Anyways, do you see any reason why an uptrend eventually will not resume? No, eventually an uptrend will resume. I just don't think it's going to happen anytime soon. Let's go over some stocks now that we've gotten over that question. You should ask us that question because we love to talk about ourselves, don't we? It's human nature. A salesperson could really work us that way, couldn't they? HMSY, well, here's a stock that was a big winner, I think, and had a big move, and so here you are rallying up into a zone where maybe it becomes shortable. The stock just had a 3-for-1 split. Maybe that's what drove the rally. But this is an example, I think, where you get this really sharp rally. It was shortable here, it breaks down, and see how it goes beyond that high, and maybe it becomes shortable in here. So let's look at this on a weekly chart. I'm not sure what I'd call this. To me, this looks like a sort of a late stage, a double bottom. It's trying to break out and it fails. So I'd call this a late stage failed base. I don't know if you want to call this a left shoulder, a head, and then another right shoulder here. But I think if you're going to short this one, you could probably hit it here. But what do these guys do? Is this a bank? Commercial, oh, healthcare. This is a thin one. So, you know what? I don't think, let's see what the average daily volume is here. 541,000 shares. I would not mess with this one. Too few shares. So, I like to see stocks trading 1 million shares or more if I'm going to be shorting them. If you get a $150, $200 stock, like CRR, for example, this thing trades like $72 million in dollar volume a day. So that's one exception I would make. But, you're looking at a stock like this, and it is a $25 stock. It trades 540,000 shares a day. I'm not playing. Okay. No pocket pivot? No, because this is V-shaped. So it would not be a pocket pivot. Am I correct there, Dr. K?
Yeah, the pattern's not constructive at all.
Yeah. You're welcome, John. Fossil. Here's another one. And you know what? Go through your lists. Go through, if you've made a list, and hopefully you have a list of stocks, at least the ones that we've talked about, on these webinars, and go through your list and see where these things are rallying up to. And if they look like they're in an area like this where they could be shorted, then take a shot. Like I said, you come in with a 10% position. If you're setting a 3 to 5% stop on the upside, what's your risk? 0.3 to 0.5% to your portfolio. If you can stomach that, then yeah, you can take the shot. And then if you work it a few times, maybe you get stopped out real quickly and you take 2 or 3 of those losses. Finally, you get a nice position on a real turn, and you're making 5, 10, 15, 20% on the downside, say. You're making to make up for that. Hopefully, you're bigger once it starts to fail and confirm the failure. So, can you use gap downs to short? It depends where the gap down occurs. If you have, and this is a great example right here. Notice how stock comes down, and then you gap down. Okay, that is a exhaustion gap to the downside, and then you get another gap down. That's really the exhaustion gap to the downside. So you obviously aren't going to short here, but you can see, and I think one of my favorite examples is Spura. Which was a late-stage cup with handle back in 2007. Did that one? No, that didn't have a break gap down. Dr. K, do you have an example offhand of a gap down where stock gaps down and falls out of a base and you can short it and it continues lower from there?
That's a good question. There's so many gap downs. But
yeah, this sort of gap down might be playable because you've already undercut this low, you rally up, and then you gap down here. That's possible, but it's a lot harder on the downside, and we haven't really studied downside gaps. Usually when you're shorting, the stock's already starting to break down, so you're into it a lot earlier than that. And usually the downside gap is caused by news, so you really wouldn't have been in a position most of the time to short it. Shorting, in this case, here's one. This thing breaks off the peak, and you could have shorted that gap, but it's not clear if you had shorted here or here during the intraday range or in the intraday range. You could have closed at the peak, which could have stopped you out, and then it rolls over. So it's harder. But if you like to take on risk and you think there's momentum on the downside, yeah, I would tend to want to do it though on something that's breaking on a gap down closer to the peak, rather than after a long downside move. So that's really the situation there. So we've got an hour now. Fossil is not a pod setup. It would only be a pod setup if it rallied all the way back up within a few weeks or 2 or 3 months. But what it's turning into now is a head and shoulders. Here's your big head. So to me, this is now becoming a potential to set up a really ugly right shoulder after this really ugly head, and so this is just choppy, and I would wait for this to form. You can use the example of Crocs back then. This is some of these patterns like CRR, and even Biogen is looking like that, and Fossil and all these things breaking down. It spends several weeks going sideways after the breakdown before it rolls over. So and you're seeing that in a lot of stocks, and this is why it argues for a rally. You broke, for example, you broke down here, so you got a shoulder, a head, and you undercut this low, so that's a logical place for an undercut and rally. So now you're rallying, and really this needs a right shoulder, but I wouldn't expect this shoulder to get too much higher from here. To me this looks like this may be the end of it here, but we'll see. It's really going to depend on what the market does. But if this were to form another right shoulder, then there you have a head and shoulders. And I think that's the situation with a lot of these patterns is you've seen a very sharp break off the peak on the weekly chart, and now you're in a position where you need to form some right shoulders. So it's really not clear to me necessarily that you can make a lot of money on the short side. I do think you can day trade things here. And like I was pointing out, you could have hit Cena this morning, you can hit Sohu off of support. Let's see, keep an eye on MOS here. Mosaic, which is right up in there. A lot of these could be shortable here, and they could break down. So, or they could hang out here for 2 or 3 days and then break down with the market. But it's going to depend on the market. So, I think on a stock-by-stock basis, you have to see what position you're in as far as the pattern goes. So, anyways, that's pretty much it for now. Dr. K, any parting comments about the market? How would you handle this environment right now? Would you be in cash? Would you be trying to buy the metals on pullbacks?
I think the best way to put it is, either be on the safety of the sidelines, or if you're exposed to the market, then I assume that means you're going to be in silver or gold, and you can use a constructive pullback as a pyramid point. Alternatively, you can just use upward price momentum to add to your position, because I do believe that these vehicles will go higher in the ensuing weeks and months. And then on Friday, that should be a good indication of where the general market might be headed, based on how it reacts towards Bernanke's speech.
Right. Now I'm going to ask you a question that maybe can be insightful for some of our listeners or viewers or webinoids, whatever you want to call them. You're going to be in Moscow until early next week.
Right.
And, normally with other partners, business partners, I'd be concerned that they're kind of sloughing off. But as I know, you will be, wherever there's Wi-Fi, you're on the desk. And so if the market switches to a sell signal again, what's going to let you know while you're in Moscow?
Oh, well, I'm always tethered to the internet, even if I'm off the desk, through my iPad and iPhone. So, if I'm in a meeting, it's not a vacation per se. It's not 100% a vacation.
Right.
I'm meeting with scientists over there.
Yeah.
So if I'm in a meeting, and I'm obviously going to have my phone on with the alerts. So I'm always ready for any kind of action if the market, serves up something that's unexpected.
Right.
So that's
so
all.
You said there is a chance
that I'm going to be I will be out of range for a period when I'm on the plane, but then about that, so then you
right, so we account for that. But for the most part, you have your alerts set on your iPhone and your iPad, and when they go off, then you know when to act. And so that's just kind of a lesson. If you have positions and you're just setting alerts, you can go away, set the alerts, and just leave it alone. So right now what we're doing here is looking to come in again on a sell signal when that occurs, or if we get a much more substantial buy signal going from neutral, which would be another follow-through day. So that's kind of where we're at as far as that goes. And really all you need is a phone alert. And we have Bill Griffith, our trader, is always here to start buying or selling or shorting or covering whatever needs to be done. So anyways, that's it for now. We're kind of in no man's land right now, waiting to see how this rally goes off. Silver not looking good, and probably a sell here, or depending on where your stop is. But that's fine. Just go back to cash and wait for the next movement, and that may take some time to set up. In the meantime, we may be coming into another sell signal. I say less of a chance of a buy signal, but whatever comes, we'll take it and just see where that goes. Meanwhile, you have individual stocks. You can look at shorting, but remember, keep them tethered on the short leash. Using tight stops, usually the high of the day if you want to come in and test here, or any of the days over the next few days. Okay, and that's pretty much it, you guys. Thanks for listening, and we will catch you all next week probably. All right, take care.
So long, everybody.